Welcome to the week ahead. This isn't a hype show, it's not a prediction contest, and it's definitely not a place where we try to trade every headline. Each week, we're going to step back from the noise and focus on what actually matters, the signals shaping capital, policy, and markets over the next decade, not just the next day. All right, let me start here. So we just got back, my family and I, from a few days in visiting family in Denver, Colorado. It was a slower pace, which was really nice, and we got to meet our newest nephew, which was wonderful. But then you come back to a week like this where everything feels like it's moving again. We've got markets near highs, political noise is picking up, layoffs in one corner, and then on the other corner, we've got record spending in another. So it is a lot. And if you're not careful, it can pull your attention in the wrong direction. The real story right now isn't what's loud, it's what's changing underneath. And this week, there are three signals that actually matter. Not for the next 3 days, but for the next 3 to 5 years. Now, you may have seen this. The Department of Justice dropped its investigation into Jerome Powell. Now, on the surface, that sounds political, and it is, part of it at least. But the better signal, it likely clears really a path for Kevin Warsh to potentially step in as the next Fed chair. Now, this is where investors tend to get tripped up. They hear new Fed leadership and immediately think, well, what's this going to mean for interest rates next month? And that's really the wrong lens. The better question is, what kind of monetary weather are we stepping into over the next decade? Because the reality is the Fed, it doesn't operate like a light switch. It's much closer to a thermostat. Small adjustments, measured moves, and data-driven decisions. And that doesn't change overnight just because a new name is on the door. So yes, leadership absolutely matters, but the institution itself is designed to move slowly and deliberately. Now, how does this apply to you? Don't let political headlines pull you into short-term decisions. Your portfolio isn't built for a news cycle. It's built for a full market cycle. And reacting to every headline, that's usually where discipline starts to slip. Now, let's shift gears, because there's something happening globally that isn't getting a lot of attention, but it probably should. And that's the U.S. engaging in direct talks with Iran's foreign minister. And at the same time, we've got this extended ceasefire in Lebanon. And that combination matters because for a long time, the Middle East has been viewed as a source of instability. And in many ways, it has been. But what if that starts to change? There's over $11 trillion in sovereign wealth in that region, with half of that in just 4 countries. It's a staggering number. So if you think about it, if stability improves even incrementally, that capital, it's not just going to sit still. It moves, it invests, it's going to partner. And increasingly, it can align with the U.S. So instead of thinking about the region as a constant risk, I think the better way to start thinking about this is almost that region as sort of this geopolitical swing state. Now, how does this apply to you? Well, markets don't just respond to bad news. They respond to less uncertainty, and that's key. So when areas of the world that used to create volatility begin to stabilize, well, that's quietly supportive for us as long-term investors. We don't need to act on it. We just need to recognize the direction that things are moving. Now, the final signal, and one that I want to talk about, is one that feels, I think, the most uncomfortable at first glance, and that is tech layoffs. We've had roughly 81,000 so far this year, and I get it. Those headlines catch your attention. They certainly catch mine, but they sound like something is breaking when, in fact, if we take a step back for a bit, underneath that, something else is happening. Productivity, which just measures output per worker, it's running at or above around 2%. Now, that's not weakness, that's really efficiency. And what we're seeing is a shift from what we call headcount growth to output growth. So companies are trimming in certain areas so that they can reinvest heavily into AI infrastructure. And this isn't a retreat, it's really just a reallocation. So, the other point that I'd make is historically, productivity growth like this is one of the biggest drivers of long-term economic expansion. It also lines up with what we consistently look for in businesses when we invest. If you think about it, companies that can do more with the same resources, become more profitable, expand their margins, and generate real cash flow. So how does this ultimately apply to you and to me? Don't automatically equate layoffs with economic weakness. Sometimes it's about becoming more efficient, not less stable. And from an investment standpoint, the companies that tend to win are the ones that do a few things, but mostly that improve productivity, that stay disciplined with their capital, and that turn innovation into actual earnings. So that's really where the focus should be. Now, what are we watching this week? Now, if we look ahead, we've got a big midweek setup. This on Wednesday, we've got the FOMC rate decision, which is just the Federal Reserve deciding what to do with rates and interest rates. We've got earnings from Alphabet, Microsoft, Amazon, and Meta. Thursday, we've got Apple reporting earnings. So it's a very concentrated moment this week because it's not just about earnings. It's really a test. Are the massive investments into AI that we've been seeing this year and really part of last year, is it actually starting to show up in revenue? And at the same time, with the Fed, it's the question of, are they comfortable enough with inflation to stay patient? So that intersection between what we'll call policy and profits is really where the real signal will be. Now, I'll leave you with this. Last week, I was actually in a car accident. So my little Honda Accord was totaled. I got pushed across a couple lanes of traffic on 485. And so any of you who have to or had to commute on 485 know how busy that is and how crazy that can be. But somehow I walked away with just a sore neck and a sore back. And the thing that stuck with me wasn't really the accident itself, but it was more the realization that in a moment like that, you don't have time to think. You don't have time to react perfectly. But what you do is you tend to fall back on whatever you already had in place, right? So the seatbelt on, paying attention, doing the basic things you're supposed to do before anything goes wrong. And that's really what actually matters. And honestly, investing isn't all that different because, markets are going to have their moments. Things move fast, headlines get loud. And when that happens, you don't suddenly become a better investor in the moment. You fall back on your preparation, right? Our allocation, our diversification, and the discipline that we create when things are calm. So when things feel a little chaotic, just remember, the goal isn't to predict every turn. It's to build something that can handle the road, even when it gets messy. Let's stay disciplined, let's stay prepared, and keep moving forward. And I'll see you next week, prepared